The Fed just made its most dangerous move yet, and 2026 will be a nightmare. Alright guys, stop what you're doing, because what just happened might be the most important financial event of December and maybe of all 2025. The Federal Reserve has officially cut interest rates. And this single decision doesn't just shift the economy. It sets up a dangerous, irreversible chain reaction for 2026 and beyond. Jerome Powell has lost, Trump won the showdown. And, for the first time since 1980, the independence of the Federal Reserve is hanging by a thread, despite a tariff war heating up, despite inflation rising, despite every warning sign blinking red. The Fed cut rates anyway, and this is before Trump's pick, Kevin Hassett, takes his seat at the Fed in 2026. So buckle up because the promises the Fed made, they're about to evaporate. The three things now baked into the cake. We are entering a world where three brutal realities are locked in. 1. The dollar's dominance is starting to crack. 2. The US debt crisis cannot and will not be stopped. 3. Inequality is about to explode to historic levels. Powell, himself, basically admitted the nightmare. Inflation is rising because of tariffs. Goods inflation is picking up. And then, unbelievably, he cut rates anyway. He calls it a one-time increase in prices, but the real truth is brutal. The tariff-driven inflation hasn't even fully hit yet. The real wave arrives in 2026, and yet, rates are being slashed now. This is not normal, this is not rational, this is not economic management, this is political pressure, industrial strength. The cut that makes no sense. Let's break this down. Historically, rate cuts happen when the economy is dying. 2008, housing meltdown, rate cuts. 2020, pandemic collapse, rate cuts. But today, the Fed is cutting into strength. GDP for Q2, 3.8%. Inflation sticky. Tariffs adding fuel. And now the Fed funds rate has plunged under 4% landing at a lower bound of 3.5%. This is inflationary rocket fuel. Why? Because Powell is desperately trying to keep the economic party going until he's out the door in May 2026, when Trump's influence over the Fed becomes absolute. Inside the Fed, the vote wasn't just divided, it was chaotic. Members openly disagreed. Some wanted rates higher, some wanted them frozen, only a handful wanted cuts. And to make it even worse, the Fed is flying completely blind. The government shutdown has broken key data pipelines. The Fed is literally making trillion-dollar decisions with missing macro data. So what we saw in December wasn't policy, it was a panic move, a break glass in case of emergency cut. But the relief valve, inflation. Look at the Fed's own projections, the December dot plot. For 2025, total confusion. For 2026, absolute chaos. Some members see hikes, some see cuts. Some see no movement at all, no one agrees on neutral rate, only 3 members want rates under 3%. This is what a central bank looks like when the political system cracks open its skull and starts reaching inside. The US deficit is exploding, bond issuance is reaching tidal wave levels, and the trade war with China means even more deficit spending in 2026 and 2027. So why is the Fed reducing rates when inflation risk is literally everywhere? Because they're cornered, and the corner is getting smaller. If 2026 brings 3 rate cuts or even 2, the Fed will have no room left to fight a recession. They'll be forced to take rates negative. Yes, negative, but here's the craziest part. The Fed is secretly printing money again. Forget rate cuts, that's just the appetizer. The real news? Powell has quietly restarted QE. Yes, quantitative easing, money printing, asset inflation, the whole thing. Starting December 12th, the Fed is buying $40 billion in treasury bills. Not over a year, not over 6 months, immediately. And that pace will continue into April. They're calling it reserve management. Let's be real. It's a bailout. Banks need liquidity. The Treasury needs funding. And the economy is dangerously close to a freeze-up. This T-bill only strategy is the smoking gun. The US is now funding its government almost entirely with short-term debt, rolling it over again and again like a gambler refinancing his credit cards every month. And the Fed, they're the lender of last resort, printing money out of thin air to keep the machine alive. This is why the S&P is exploding. Gold nearly hit $4,300, silver just broke $63, the highest ever. Liquidity is flooding into tiny markets. Everyone can see what's happening. Debasement. The money supply is about to surge, assets are being bid up, people are sprinting out of cash and into hard stores of value. Now with the Fed buying short-term debt, the Treasury has every incentive to issue more T-bills. This is why the money supply will explode next year. T-bills get rolled over every few months, interest gets recycled faster, liquidity re-enters the system over and over. The Treasury's reliance on short-term borrowing has risen from 15% to 22% of all issuance, and that was before today's cut. Now, it's going to blow past 25%, and if any crisis hits, the Fed can instantly ramp up from $40 billion, $400 billion. This is why gold and silver are going parabolic. But now we get to the biggest, ugliest problem. And yes, this is real. Look at two lines. The Treasury General Account, TGA, the government's checking account, bank reserves held at the Fed, the system's oxygen supply, the TGA has exploded to $2 trillion. That's money sucked out of the private economy. At the same time, bank reserves have collapsed to near zero. That means banks have almost no liquidity to lend, no cushion, no ability to absorb shock. If a recession hits today, the system freezes in 48 hours. This is why Powell panicked. He had to restart the printing press, and Treasury Secretary Scott Bessent. The bond market had its best year since 2020, and bonds will have another strong year in 2026. Translation: don't worry, the Fed will buy everything. Foreign buyers? Not needed. U.S. investors? Take a nap. The Fed has become the permanent buyer of last resort. Let's be very clear. The U.S. debt is $38 trillion. The annual interest bill is now $1.2 trillion. Long-term yields are rising, not falling. Rate cuts won't fix this. The government will issue more bonds to pay for old bonds. This is the classic Ouroboros, the snake eating its own tail. Lowering rates doesn't solve anything. The debt has passed critical mass. The Fed cut is not good news. It's a warning siren. Yes, asset prices may boom. If you're in the game, congratulations. But if you're not, you're about to feel it first, because the immediate victim of rate cuts is the US dollar. The DXY is already under 99. The US imports up to 20% of everything it consumes. A weak dollar means higher food prices, higher goods prices, higher energy prices, higher living costs. The poorest Americans will feel the pain first and hardest. "2026 might be the most unstable year since 2008, because Kevin Hassett is almost certainly becoming the next Fed chair. Fed independence will erode, Trump will push for more cuts, inflation will surge, the deficit will explode, the dollar will weaken, asset prices will go wild. Could rates get cut again? 100% yes. Could they cut more than once? Absolutely. Could Trump force the Fed's hand? Very likely. What happens in 2028? Nobody knows. But the pieces are already moving, and the Fed has restarted QE whether they want to admit it or not. Let me know in the comments, why do you think the Fed is secretly printing money again? Are we already back in QE without them admitting it? And what does this mean for 2026? Let's talk. Make sure to smash that like button, subscribe, and drop a comment to help this video reach more people navigating this insane economic landscape. Stay safe, stay sharp, and stay prepared.